Well, good morning again, everyone. Thanks so much for tuning in. There's an old saying that says what a difference a day makes. But in the case of the buy now, pay later sector, it's more like what a difference 16 months makes. Way back on February 19th of last year, 2021, Zipco had a market cap of around $6.7 billion. Sometime after that, CEO and Managing Director Larry Diamond spoke in an upbeat manner about the future prospects of buy now, pay later, and the fact that he was unconcerned about the increasing number of participants in the space. His view was that a rising tide would lift all boats, and that it was likely that the transition away from credit cards would continue, such that the dinosaurs of the personal credit space, that's as he described the likes of Visa and MasterCard, would become less relevant over time. Well, here we are on June 19th of 2022, a mere 16 months later. Not much time in the greater scheme of things, and Zipco now has a market cap of a mere $371 million. The summative financials from Stock Doctor for the company when the last annual report was released are as follows. Total capital raised since listing, $375 million. Total borrowings, $2.65 billion. Repayment of borrowings, $600 million. And cash at hand of $330 million. Westpac's summary of the financials closely matches the numbers from Stock Doctor, showing total debt to be $2.135 billion and cash at $330 million. With a net debt to equity ratio currently sitting at 155%, it's not surprising to see that Stock Doctor assesses the company to be in a state of financial distress. Now, that doesn't mean the company is going to go broke anytime soon, but any decision to invest in the company at the moment would have to be carefully considered, in my humble opinion. Now, of course, I can't offer any advice about whether this is a great opportunity to buy Zip at a bargain basement price, nor can I suggest the ship has almost sunk and it's time to get out before it finally settles on the bottom of the ocean. The decision to buy or sell this stock, of course, is going to have to be totally yours to make, and you'll make that after doing your own consideration of all of the factors and what the future landscape might possibly look like. Now, I did drop into my retailing friend Brian's store during the week just to ask whether he had noticed any changes in the use of buy now, pay later, and he confirmed that the use of the options that he offers had been steady but certainly had not increased over recent months, suggesting that at least in his space, the chances of Zip increasing its revenue and hence becoming profitable in the near future are not increasing at a great rate. His view, by the way, is that Zip is far and away the most merchant-friendly of the options. In fact, he's been offering Zip well before Afterpay even appeared on the scene. And he does like the company, he likes the way they work with the merchants, but that doesn't seem to be helping anything to do with the share price at the moment. Anyway, it will be interesting to see what happens in the buy now, pay later space now that interest rates are on the rise and inflation is impacting noticeably on the cost of essential items such as food, power and petrol. I actually think it's pretty hard to see how revenues for the company can continue to grow very much, as those who are attracted to their offering have probably already made the move there by now. And of course, buy now, pay later was a solution to a problem that never ever existed. And I'll be interested to see the financials for the likes of Zip when they do report to the market in August. Also wonder whether buy now, pay later is just another example of hyped up sectors, or in some cases individual stocks, attracting capital from inexperienced investors looking for outsized returns in a short period of time. Slick marketing and upbeat commentary from market participants pump up the prices to elevated levels, only to see a later return to more realistic valuations. An unrelated stock, well actually an ETF, is Cathie Wood's ARK Innovation Fund, and the stocks within it mirror the performance of Zip over the last 16 months. Many of those companies within ARK are either pre-revenue or, like Zip, have negative earnings and seem to be a long way away from having positive earnings. ARK has done a little better as far as share price is concerned, only falling by 76%, while Zip has fallen by around 90%. So right now the market is definitely behaving as a weighing machine, as Benjamin Graham would have said. And in the majority of cases, the share prices of companies with no earnings are being savaged. Unfortunate part about all this story though is that for those of us that think we are invested in high quality stocks with growing earnings, is that we are also feeling the wrath of Mr. Market. Investors who have been able to find low risk investments that are still delivering positive returns are far more savvy than I'm ever likely to be, I think. You know, the strategies that I'm employing have a history of occasionally performing way worse than the overall market, sometimes for more than a year. So the short-term pain for me may continue for some time to come. But the question is, what is it like for you? I hope that you're doing well, and I do have best wishes for you all for your investment decisions at a time when it seems certain that central banks will be hitting us with a succession of interest rate rises for the remainder of the year.